Will mortgage rates in the UK go down in 2023? This is the question on everyone's lips at the moment, and probably the question I am being asked the most right now. However, before we can understand whether or not mortgage rates in the UK are going to come down this year, there are a few things that we need to understand about not only the UK economy, but also how lenders determine what their mortgage rates will actually be. In the UK in 2023, we have seen inflation go as high as it's been in a decade, and the Bank of England's base rate been as high as it's been in over 2 decades. However, many are actually predicting that despite this, we're going to see reductions in the average mortgage rate available to UK customers, which is pretty baffling, right? Well, in this video, I'm going to talk you through actually what affects mortgage rates in the UK. There are 3 things that we need to consider: inflation, the base rate, and something called swap rates. But before we get started, if you could please hit the subscribe button. There's over 200 videos now available on my channel, and if you could give this video a quick thumbs up, it will mean a lot to me. Right, let's get back into it and let's talk about those 3 things that are going to affect mortgage rates, kicking off with the Bank of England base rate. At the end of 2022, the Bank of England base rate was at 3.5%. This was up from the beginning of the year being at 0.1%, which it had been for the better part of a decade. So quite a massive increase. At the time of recording, we're actually up to 5%, with many predicting a 0.25 or 0.5% increase in August, which would take us to another over decade high. Many believe that whatever the Bank of England base rate is, this is roughly where mortgage rates then correlate. They believe that they track the Bank of England base rates, when actually only tracker rates, the clues in the title, actually do track the Bank of England base rate, or something similar, the bank's internal base rate, which essentially monitors the Bank of England base rate. So why, if at the end of 2022 the Bank of England base rate was 3.5%, was the average mortgage rate in the UK 5.8%? That's quite a big difference. All this shows is that the base rate is not the only factor that's going to determine what the average mortgage rate is going to be in the UK. So we have to think a little bit further afield, which takes us to the next point. Inflation here in the UK is at a 2-decade high. At the beginning of 2023, the rate was at 12.6%. Now, bearing in mind that the Bank of England's Monetary Policy Committee target is 2%, that's quite a huge difference. How inflation is calculated is based on the average price of goods and services. So the higher the price of goods and services, the higher the rate of inflation. In 2023, this is what has led to something called the cost of living crisis. Essentially, inflation has got so high that for the average family, the cost of living has just got completely out of control. Traditionally, the method of curbing inflation has been to raise the Bank of England's base rate. And the theory behind this is that the higher the base rate is, the higher the cost of borrowing, the less people borrow, and the less available funds they have to then spend. The less they spend, the lower the demand for goods. This will drive down the price of goods and therefore the rate of inflation. However, to actually make this work quickly, the base rate should be above the rate of inflation, which it isn't, and it's not looking likely to be in the next few months at the very least. But this is having an impact. So is it inflation, therefore, that has an impact on the average mortgage rate in the UK? Well, actually, there's one more thing that we need to talk about. Swap rates, or SONIA rates, are the interbanking lending rates that banks use to lend money to each other and determine how much it's going to cost them to do so. Unlike the Bank of England base rate, these don't just change on a monthly basis, they change on a daily basis. And when inflation is high, or when the economy is poor, we tend to see fluctuations in these rates, which causes a massive amount of discomfort to lenders. What many people don't realise is when banks borrow money from other banks, the rate in which they borrow it at doesn't actually get locked in until you complete on your mortgage. And with the time it takes to actually get a mortgage application through at the moment, probably 3 to 6 months, that's quite a big window where lenders could get it wrong and lose money. With swap rate volatility going up and down constantly, this means that lenders have a really tough time predicting where the rate is likely to fall when you complete on your mortgage. And as a result, they're going to shoot mortgage rates up to make sure they're covering their back and not losing any margin. After all, the point of lending is to make money. It might not sound fair, but it's just business. So what affects swap rates? Well, in a word, confidence. The last time we saw real volatility in the mortgage market was at the back end of 2022, and this was as a result of the mini budget. Without going into the details, it created what we would call a volatile market. Effectively, the powers that be had lost confidence in our economy, and as a result, it was really difficult to predict what the lending rates were going to be, and this caused the swap rates to go up and down, up and down. Effectively, they were really volatile. That meant lenders had to pull rates very, very suddenly to keep up with this and launch new rates that took this volatility into account for the reasons that we've just spoken about. So if inflation's high and the base rate is high and looking like it's going to increase, why are people predicting then that mortgage rates may come down? Well, it's all to do with that C word again, comfort. What we saw recently was in July 2023, the rate of inflation came down from 8.7% to 7.9%. This was a bigger drop than many were predicting. Of course, what we're trying to do here is get the rate of inflation down. So this was welcome news to economists. Because inflation came down so well, this gave a lot of confidence back into the market, and it meant that volatility in the swap rate market was reduced significantly enough for lenders to be able to pull some of their high rates and bring back new products that were at a lower rate because they felt confident in predicting a lower swap rate volatility over a 3 to 6 month period. So if we want to predict where mortgage rates are going to be during the course of 2023, we have to think about where the rate of inflation is likely to go. We have a bit of a prediction as to the curve, and we're hoping that by the end of the year, we'll be sub 5, potentially even sub 4%. And essentially, if we stick to that curve, it's going to keep that comfort level where it should be, which should mean that we continue to see reductions in mortgage rates. Of course, if we exceed those targets, that's going to give even more comfort and see an even bigger drop. However, if our predictions do not come true and we don't see as big a reduction, this could have the opposite effect. So, will mortgage rates in the UK come down during the course of 2023? It's all going to be down to inflation, not necessarily the Bank of England base rate, because it's inflation that gives the market confidence that means that swap rate volatility will be kept to a minimum. I hope this video was really informative. Guys, if you've got any questions, leave them in the comments, and I'll catch you very, very soon on another video.